Hey team, it's Gary here. So today we're going to talk about, with all the stuff going on with Robinhood and investing and all the speculation, how to guarantee solid returns and protect your money. And we're going to give you a few principles of the stock market and how it works. And I would say this past week and what's happened on the internet, there's more information out there than there's ever been in people being interested in the stock market. But most of you are going to lose money. And a lot of it is because of the speculation and these bubbles that are being created. These hedge fund companies and other investment companies have literally an army of people out there that are researching trends and data and analytics. And, for the little guy, it's very difficult. But there's some things that you can do over time that are proven strategies to guarantee solid returns. And so we're going to talk about that here today. So the first one, I used to have my Series 6 and 63 securities license, and one of the first principles they teach you that they don't teach you in college or in high school even is the Rule of 72. And the Rule of 72 tells you how long it's going to take your money to double. So you take any interest rate and divide it into the number 72, and it tells you how long it's going to take your money to double. And it's important out there if you are investing money into a savings account, because putting your money into a savings account, we can look at the chart right here. Banks, I don't even think they're giving you 0.25% return on your investment right now. So if you took $1,000 and invested it into the savings account, divide that number into 72, and it would take you 288 years for $1,000 to grow to $2,000. Even at a 2% rate, it would take you 36 years for $1,000 to double to $2,000. And so depending on how old you are, even on those situations, even if you started investing in a bank when you were 18 years old, it's still not going to be sufficient enough to grow your money for retirement. But as the interest rates go up, what ends up happening is you can see 7, 8, 9%, then it becomes much more manageable in doubling your money. So the goal is to increase that interest rate and get the best return that you can over time. But it does give you perspective out there if you're putting your money into a bank account. The second one is dollar cost averaging. This is huge. We're going to get into the cow business here. We're going to talk about investing in cows and why investing in cows and dollar cost averaging can be lucrative either way you go. But dollar cost averaging is basically investing a set dollar amount each month consistently into an investment portfolio. So if you had $6,000, rather than putting that money in all at once, you want to spread that out over time. And that way you can get the highs and lows of the market, and we'll show you what that looks like in our investment case study here. So in this case, we're going to get into the cow business. We've got two investors, Jimmy Joe and Billy Bob. Both of them are going to get into the cow business. They've decided to invest $100 a month each month for 10 months. And we're going to see which strategy gets the higher return on investment and the overall lesson here. So the first one, Jimmy Joe, first month, basically the first month they both invest $100 a month. The price per cow is $10. Each of them buy 10 cows. Very simple. The second month, we're going to go here. So the second month, the price per cow drops on Jimmy Joe. So he's a little concerned because now he's lost 5% of his investment. But that month he bought 11 cows. Well, Billy Bob, the price of cows went up 50 cents. So he bought 9.52 cows, but his total return on investment is 2.5%. So he's happy. He sees the prices appreciating and life is good. On month 3, price of cows, man, it's tanking. And Jimmy Joe is freaking out. He's lost 10% of his investments. He bought 12 and a half cows this month. But he's not a happy camper. Billy Bob, on the other hand, he's sitting there rubbing it in Jimmy Joe's face, and he bought, price of cows went up another 50 cents. His investment's up 5% over 3 months. Month 4, Jimmy Joe's freaking. Jimmy Joe's freaking out. Price of cows have plummeted. His total investment is down almost 25%, where Jimmy Joe's investment continues to grow. He's up 7.27%. So he sees the future. Jimmy Joe, if he's married, his wife's considering divorcing him. If his girlfriend's considering breaking up with him, and everybody's telling him he's a fool. Now it's getting really bad. You can see on month 5, Jimmy Joe's lost 30% of his investment. Billy Bob is up 9%. But on month 6, the tide turns. The tide turns. On a $100 investment, the price of cows went up for Jimmy Joe. So now he's only lost 13% of his money, where Billy Bob is up 11%. But Jimmy Joe sees the light. And as you can go through, as the price of the cows go up, there's a little bit more optimism. By month 7, Jimmy Joe's breaking even. And most of you that invest in a 401k consistently and you see the stock market dropping, this is where you pull your money out. And this is why most of you fail, because once you break even, you're like, I'm taking my money out. I'm never doing this again. The price of cows are still down. But Billy Bob is happy. Life is good. He's up 13%. Month 8, the price continues to go up. Billy Bob still has a 16% positive return versus a 13%. And then, but by month 9, the tide dramatically turns. And as you can see, by the 10th month, Jimmy Joe started off at $10 a share, or excuse me, $10 a cow, and he ended at $10 a cow. He had a 34.84% return, where Billy Bob only had a 20% return on an appreciated market. So what is the better strategy here? Over time, if you dollar cost average a set number of money, you statistically will have a better return on investment versus an appreciating market. So if you're investing right now and we have this huge bubble out there in the stock market where stocks are trading at an all-time high during a pandemic, and you started and the market started crashing next month, and you started investing every single month on a downturn market, and you did that, say for 5 years, and the stock market crashed for 2.5 years, and then after 2.5 years, it started going back up, and you ended up at the same, you will have statistically a better return on investment than the guy buying in an appreciating market. It's very, very important. So here's why you will fail. Here's why investors fail. And this is an important lesson I learned by a guy by the name of Bill Maddox at Shearson Lehman Brothers. Is a stockbroker or a stock brokerage firm like Robinhood, E-Trade, Ameritrade, Schwab, their best friend is a bored investor. All of you out there, when you're playing the short game, it's gambling. I play the short game just for craps and giggles. Like, why not? Why not play the short game? Why not get in there and gamble a little bit of money? But over time, you don't want to invest what you're willing to lose when you're playing the short game. So if you've got money to throw around and you're doing that, great. But if you really want solid returns on over time, you need to be disciplined and have patience and dollar cost average those investments. So one great book that you can read on this is a book called The Healthy Barber. You can get it by clicking the link below. It talks about a barber, just lived an average life as a barber, investing in the stock market, investing in investments, and he retired a multimillionaire. And you see this with post office workers that retire with millions of dollars, teachers that retire with millions of dollars because they invest a set solid amount over time, and they grow those investments to create the future and the retirement that they want. So anyway, please subscribe to this channel, click the links below, and if you have any questions, reach out to me, just comment below. Thank you.